My name is Zach, and this is Dividend Data. In today's episode, we will follow me through a week of investing as I analyze stocks, set buy orders, and show my daily changes in portfolio value as the market moves. One big piece of news will be Disney stock, which is reporting earnings on Tuesday. I own it in my portfolio to the chagrin of many of you viewers, so I'll be covering that in this video. Also, I'll cover any other interesting news in the week as it comes across my desk. But before we jump into the content, I just have to mention that the Berkshire Hathaway annual meeting was this past weekend, and it was great. I recorded a bonus video giving my live reaction and thoughts. It's always nice to hear from Warren Buffett, even as he's 93 years old now. Also, they made a great tribute video for Charlie Munger, and he got a standing ovation in the crowd. All I'll say is that was well deserved. I should also mention that I had a little bit of fun, and I made some Buffett-related merch this weekend, my first merch launch ever. I'll give you a little bit of a hint. It has an election theme, and I think we can all agree that the main problem with 2024 presidential candidates is they are too young. That's the problem. So I suggest Buffett Munger 2024. What could be better than a 93-year-old and a dead man? So anyway, I thought it was funny and I kind of made it for myself, and I designed a logo, and it's on hats, t-shirts, magnets, stickers, etc. Go to shop.dividenddata.com if you want to check it out and buy some like I will be doing, or don't, because I really just made it for me. I thought it was funny. All right, so who's ready to rumble? Imagine if I did that every single episode. I just turned into Bruce Buffer. Who's ready to invest? All right, let's roll the intro. All right, so it's Monday. I have dividenddata.com up here, which is where I track my investments. Here, I'll close this down so you guys can get a better view. So across all my accounts, we're at $222,400. For Monday, we're up 1.2%, which was about 2.7K, and brings the overall total return to 59.92% or 83K. And the major movement for the day, Microsoft up 1.69%, Tesla up 1.97%, Altria down 0.23%. Other big movers, Disney up 2.47%. They report earnings tomorrow morning from when I'm recording this, so that should be pretty. I'm expecting a big move up if they have good results. And in terms of my buys that I have set right now, I'm really only targeting Visa and Starbucks, which just crashed, and I covered that recently in my last video. With Starbucks, I'm basically just kind of like dollar cost averaging down, and it's a very small part of this investment portfolio and will probably still be a very small part of it by the time I'm done adding, unless it really crashes. And I would also have to gain more confidence into the long-term thesis around the company. But Visa, I have a buy-in at $266, so I'm hoping that we get back down in the week sometime to add more. But other than that, I don't have a new dividend coming in until May 14th and May 16th, so no dividends this week. Speaking of Starbucks, some of you may have gotten an email from me this morning on Monday, and I should probably explain a little bit of that. So I've had the idea for a while to do a newsletter because I thought it was kind of like a natural step with, I got dividenddata.com, I got the YouTube channel, it would fit well into the ecosystem. But I didn't want to divert my time anymore. So I recently connected with someone I've known who does a newsletter, and they do a great job. And they will be partnering to help me do Dividend Data weekly, which is what we're calling it. It will release every single Monday before market open, so you can start and end every week of investing with Dividend Data. I'm still helping with topics and making sure that it's something useful for you guys. That was my key metric. I want it to be something useful so that you can open it every Monday, and it either gives you information that will help you throughout your week of investing, or it puts you in the right mindset to start the week. Sometimes it might be quotes from legendary investors or a key news story, dividend increases, decreases. It will be similar to a lot of content I already have on the channel. For example, this first issue, we talked about Starbucks earnings, linked to that crazy Jim Cramer interview. That was wild. Gave some useful links from news throughout that week. Dividend dates coming up, and of course you got to throw a little meme in there. So I'm pretty excited about that. I think will be a great addition to our content ecosystem. And again, from my standpoint, the great part is it won't take up that much time away from doing YouTube, which I'm recommitted to weekly basis, new episodes, and future website development, which is the number one focus. Also, analyzing stocks in the market. That's like half my job as well. If you want to join, link in the description and pinned comment, and I'll go back to the regular content. So done with that. Only mentioned it because we just released it this morning. All right, so I'll be back tomorrow to cover Disney's earnings and the results. I'll break it all down, give my analysis, see which way the market's reacting. It will be very, very interesting. All right, guys, I'm back. Disney reported earnings today, and the stock is down 9%. Now, this was vastly different than my expectations. I thought it was going to be a pretty good quarter. So I'm going to look into the earnings report and see if I can figure out why the stock is down. And this will be a little bit of a behind the scenes, so you can see me analyze a stock live, what I look for in their earnings, and how I think about the process in general. Also, I'm going to listen into their earnings call and share any interesting clips from that. Plus, the Disney CFO was on CNBC this morning, so I'll play a clip from that and react to it. So we got a packed schedule. Let's get to it. All right, so this is their second quarter earnings report. Revenues for the quarter increased to $22.1 billion from $21.8 billion, so a slight increase year over year. All right, so we're already getting interesting. Diluted earnings per share was a loss of 1 cent for the quarter compared to income of 69 cents in the prior year quarter. Now that is interesting and probably a reason why the stock is down. Why did they actually lose money? Because that really doesn't make any sense with how they've been operating lately. And if we keep reading, diluted EPS decreased to a nominal loss due to goodwill impairments in the quarter. All right, so what is goodwill impairment? Goodwill impairment occurs when a company decides to pay more than book value for the acquisition of an asset, and then the value of that asset declines. The difference between the amount that the company paid for the asset and the book value of the asset is known as goodwill. The company has to adjust the book value of that goodwill down if it becomes impaired. So this is not an actual financial loss in terms of cash in and cash out of the business. This is what I would call bullshit accounting, because I don't even factor in goodwill in most of my analysis. I focus on cash flow generation. But I am kind of curious what they wrote down in the quarter. And this can negatively impact the stock. For example, Altria for a couple of years there was writing down the value of their Juul investment, and that was a huge hit to their net income over the year. But their cash flows remained really high and strong during that time. So if we exclude this goodwill impairment, diluted earnings per share for the quarter increased to $1.21 from 93 cents in the prior year quarter. So as expected, the company did grow. So they go on to talk about how they had strong double-digit growth in adjusted earnings per share, and that for the full year, their EPS growth target is now 25%. Which is strong. So why is this? The main factors are they're cutting costs dramatically and streaming is finally becoming profitable, not a business which loses billions of dollars a year. They go on to say we remain on track to generate approximately $14 billion of cash provided by operations and over $8 billion of free cash flow this fiscal year. Now that $14 billion number, that's an all-time high. The company is now generating the most cash it ever has. They repurchased $1 billion worth of shares in the second quarter and look forward to continuing return of capital to shareholders, according to plan. And this is a gigantic next bullet. I am so surprised that the stock is down today based on this. The entertainment direct-to-consumer business was profitable in the second quarter. Now, their guidance previously was that they were expecting to hit profitability in the fourth quarter of 2024. So they are already ahead of progress in that regard. We continue to expect our combined streaming businesses to be profitable in the fourth quarter and to be a meaningful future growth driver for the company with further improvements in profitability in fiscal 2025. So 2024 is the year of turning profitable. 2025 is the first year of actually having that be meaningful in terms of profits. Disney Plus core subscribers increased by more than 6 million in the second quarter, and Disney Plus core average revenue per user increased sequentially by 44 cents. Very strong performance. Every quarter is not going to be a big subscriber gain, but in the long run, I do see a continued path for future growth around the globe. And, over 5 years or so, they might be at the scale where Netflix is now. The experiences business, which includes their parks and consumer products, was also a growth driver in the second quarter with revenue growth of 10%. Segment operating income growth of 12% and margin expansion of 60 basis points versus the prior year. But they go on to say that in the third quarter, they expect operating income to be roughly comparable to the prior year. But they do expect robust operating income growth at experiences for the full year. So listen, those are like great top line highlights and everything I was expecting for the quarter. And I was expecting the stock to go up from that result. So if anything, I might even actually buy, and I haven't bought Disney stock in a while. That's my intuition right now. I'll keep reading, I'll listen to the earnings report, etc. All right, so here's the summarized financial results, and the big thing I want to focus on here is that cash provided by operations came in at $3.6 billion, which is up 13% year over year. Free cash flow came in at $2.4 billion, which is up 21% year over year. And what this means is Disney is raking in the cash now. What does that mean? Growing dividend, buybacks, pay off debt, invest in the company. It's a cycle, and this is much needed after they went through a 2 to 3 year period of just pain in that regard. So then we can look at it by segment. They have entertainment, sports, and experiences, and we'll break down each of those individually as well. So entertainment revenue is down 5% year over year. Sports revenue was up 2% year over year. Experiences was up 10% year over year. And although entertainment revenue is down, their operating income from that revenue was actually up 72%. And that's from major cost cutting in streaming. We'll get to that. Sports operating income was down 2%, which is pretty negligible. And then experiences operating income was up 12%. So overall, we have this 17% increase year over year in operating income, which is really solid. But if we dive into that entertainment business, this is where it gets really interesting. They have the old legacy linear network business. This is their cable TV channels. And then they have direct to consumer, which is their streaming services, Disney Plus, Hulu, ESPN Plus. So cable is a slowly declining business, but it actually is starting to get notable. And I would actually say that this result here is the most negative part of the earnings report, more than that goodwill impairment. I don't really give a shit about that, to be honest. But the decline of the linear networks business is something that will be a problem and drag on the stock long term. However, what we have to factor in is that the growth of direct to consumer is outpacing the decline of linear networks. In terms of revenue, direct to consumer is already at $5.6 billion compared to $2.7 for linear networks. And direct to consumer revenue grew 13% year over year, while linear networks declined 8% year over year. However, the big difference with those two businesses is profitability. Linear networks is extremely high margin for Disney. Even with significantly less revenue, they still profited $752 million in the quarter. And that was a 22% decline year over year. That is the biggest red flag in this earnings report. And if that continues, that will be a problem, although it is increasingly becoming a less important part of the company over time. Despite that, they still saw overall growth in the quarter for operating income of 72%. It's because direct-to-consumer losses for the quarter went from negative $587 million to positive $47 million. That is the first profitable quarter for Disney streaming services ever. A major milestone. Like, this is significant. And if we look at the past 6 months, it went from negative $1.5 billion to negative $91 million. So this is a huge cut in losses. What really will be interesting is when these direct-to-consumer streaming services become more profitable than the linear networks. That's the moment where everything flips. And your most profitable thing in entertainment is suddenly a growth business, because linear networks is not a growth business at this point. They can still use the cash flows and it's nice. It's still very profitable and will probably stay that for a while, but it's not something that people get excited about in any ways. It's not going to be a much bigger business in the future. If anything, it will be a smaller business. All right, so Disney Plus core subscribers, which is the actual high paying ones, domestic and international, that is up to 117.6 million subscribers, up from 111.3. That's a 6% increase for the quarter. Disney Plus Hotstar declined, and this is from the continued loss of their cricket rights, etc. in India. This is their Indian streaming service. I personally don't care much about that, because if we go down here to average monthly revenue per paid subscriber, they only have 70 cents per subscriber. So this is like not a meaningful money contributor. Meanwhile, Disney Plus core subscribers have $7.28 per subscriber, and that is up 6% from last quarter. Hulu is up 1% to 50.2 million subscribers, and it is still monetized very strong. And they actually, in this past quarter, they just rolled Hulu into Disney Plus, where you can watch it all in a one app experience, which is a nice idea. And I believe they just announced that at the end of this year, they're going to be doing the same with ESPN. That'll be another huge thing. I think live sports and streaming is the eventual future of that. And I do think it's a really good idea to combine all the different services, and if you have all of them, being able to watch them in one place. All right, so now we can look at sports, and this was not that notable for this quarter in my opinion. Revenue was up 2% year over year, and operating income was down 2% year over year. So it was a slight increase in costs, and top line grew a little bit. And with ESPN, it's the number one most profitable linear TV asset by far, not even close. But in terms of the future, the main thing we have to focus on is that digital transition to streaming. They have ESPN Plus, but it's a partial, not real version of ESPN. It doesn't have all the live sports, but they're planning to launch an ESPN solo streaming service, and they'll be folded into Disney Plus if you pay for it as well, same as Hulu. And that will be a big step towards the future of ESPN. They also announced that joint venture with Warner and Fox Sports to combine all their different sports rights in a different streaming service that's cheaper than cable. And I think that's also a great idea. So I do feel pretty good about sports long term. And you guys know me, I'm a Pat McAfee fan. That was a fantastic signing by them. The Draft Spectacular got awesome ratings. They had Bill Belichick on. It was awesome. Also, side note, this past weekend, the Tom Brady roast on Netflix was awesome. Netflix is doing a killer job with a lot of their live programming, but this is about Disney. At this point, they can only dream that their streaming service is as good as Netflix in the future. All right, so if we look at experiences, this is like one of their best parts of their business. Overall revenue is up 10% year over year to $8.3 billion. This was led by their parks business, mostly domestic, which is Disney World and Disneyland. They made $5.9 billion in the quarter, which is up 7% year over year. International parks grew 29% year over year to $1.5 billion. And with operating income, the segment's up 12% year over year to $2.2 billion. Domestic parks are up 6% to $1.6 billion, and international parks are up 87% to $292 million. And that's from the continued reopening over time, because the international parks lagged significantly compared to the parks in the United States. Consumer products made $387 million in operating income for the quarter, which is up 7% year over year. That's a good quarter for them. So when we look at this kind of experiences business, you really see how diversified their business model is compared to something like Netflix, where they're streaming only. They monetize their content and intellectual property through all these different channels. And in the same way, you could argue that Disney could only dream at this point of having a streaming business as good as Netflix. Netflix could only dream of having a content ecosystem business as good as Disney. I mean, these parks are insane moneymakers. And with consumer products, licensing, all that, that's a huge opportunity. And here again, you can just see the massive change in free cash flow generation. So this is over 6 months, so half of a year. They made $3.2 billion in free cash flow. And in the prior year's 6 months, that was negative $168 million. So this business is finally turning around. Bob Iger is doing a great job financially speaking, and it's showing up in the numbers. He's making the right moves, the right decisions, like the same things I would do if I was in charge in regard to the business. I know socially many of you have problems with everything, but who doesn't? That's the world these days. All right, so that's all I'm going to break down from this earnings report. I'll listen to the earnings call, come back if there's anything interesting, and I'll probably be watching with you guys that CFO interview. Their new CFO is the guy from PepsiCo for a long time. I think his name's Hugh Johnston. He does a great job. I've liked him at PepsiCo. So I think that's a good hire for Disney, and I hope he stays long after Bob Iger's gone too. They need that management stability and transition. All right, so I'm back. I was listening to the Q2 earnings call, and I found another reason why the stock may have gone down. Now, they mentioned this in the earnings report, but the CFO, Hugh Johnston, highlighted this for a couple minutes here, in that for their parks business, they expect Q3 to be flat year over year. And they are definitely being cautious with all of the phrasing they're using. Hugh went on a rant about all the various challenges they see, like rising wages, and plus he was saying that they're starting to see signs of the first kind of dip in travel since there was that massive post-COVID surge and people wanting to get out there and experience things. So he is being cautious with his warnings here. And I wonder if this line of being super cautious is them reacting to what happened to Starbucks, where they set expectations very high and missed completely. So I wonder if they're just setting expectations in line for the next quarter. But long term, this does not change really anything about how I think about Disney as a business. So I'm good over here. Also, I thought I should mention what that goodwill charge was. It was $2 billion related to Star India and their entertainment. That was part of their deal when they bought. 21st Century Fox and that whole entertainment And yes, in my opinion, this was the worst part of the deal. But so anyway, I'll get back to you next time I find something worth sharing. All right, guys, done with the earnings call. It was interesting. I don't want to bore some of you guys, though, who's same old corporate talk. But now the CFO is about to go on CNBC, so I'll be watching that, and I'll cut to any clips that may be interesting to share with you guys.
I think Joe's got a question for you.
Yeah, I'm just trying to figure out streaming, Hugh. It'd be nice to be profitable, obviously. Andrew referred to it like as the holy grail for the fourth quarter. I mean, okay, so you break even, you're slightly profitable. Do you see 20% growth year after year at some point? Does it ever get past digital nickels that we traded for analog dollars? Does that happen?
I think it does, Joe. It's a great question. Look, the overall entertainment business is a fundamentally healthy business, right? You basically see eyeballs moving from one channel to another channel, in effect, going from cable to digital. Obviously, there's margin implications initially, but as we scale over time, I think we ought to be able to equalize those margins out, or at least get them closer so it becomes less of a factor for us. So, yeah, I actually think that building that streaming business and making it into an important growth driver for the company is a really good idea because the margins are going to be there for us. Now, what do we have to do in order to do that? We need to deliver quality programming. We need terrific engagement, and obviously bundling helps a lot with that. We need to work on password sharing because that's actually a terrific growth driver for us. We need to get our distribution costs down, and we need to use technology so that we can market directly to consumers and also give them good recommendation engines. By virtue of doing that and ultimately building out an international business, I think it's going to be one of the great growth businesses for the Walt Disney Company.
That was a great answer by Hugh. I've liked this interview so far for the most part. I'm glad they hired him as their new CFO. I think it's very difficult to argue that Disney's streaming business can't be very profitable into the future, considering Netflix, which we'll say is at like a 3-year head start in terms of profitability, Netflix is becoming a cash cow itself. I don't see any structural problems related to streaming that it can't become a high margin business at a larger scale than cable ever was. It may take some time to get there for sure, but I do think it will get there. All right, guys, so to wrap up this whole Disney segment, let's look at the stock right now, how it's valued, and how we should think about whether it's a buy, sell, or hold. All right, so the current market cap is $193 billion. And this fiscal year, they're projected to generate $8 billion in free cash flow. So that means they are trading at 24 times annual free cash flow. Generally, I would say that's pretty fair value for a company like Disney. But that $8 billion in free cash flow may just be the start as streaming becomes profitable and they continue to invest in their parks business. In fiscal 2026, that might be $12 billion. Which is about a 16 times multiple. And with this cash flow, we have dividend growth returning, plus we have share buybacks, which are starting. In the most recent quarter, which my software hasn't updated with yet, in this most recent quarter, they bought back $1 billion in shares. The return of share repurchases and dividend growth is really going to help this stock long term. Just generating high cash flow in general will solve so many problems related to this company. 2020 through the first half of 2023, it was a disaster, dude. So how do I think about it in context to my investments? So I have Disney in my dividend stock portfolio, which I update on the channel, and biggest loser on the day, and my worst investment of all time. And I've gone over this before, but it was a big learning lesson for me because I did not factor in the losses of the streaming business, and I kind of got caught into the future promises, the top line revenue growth, the top line subscriber growth. And I wasn't factoring in the fact that that peaked at $1 billion a quarter in losses. What? Dude, that is not sustainable. But now we're on the other side of that, and they have really focused on cost cutting and profitability. So in a world where I didn't own Disney stock, I would probably want to open a position right about now. But given that I already own it, and I probably own more than I realistically want to, I might just hold or nibble if it gets back down into the low 100 or 90s. And what I mean when I say I might own more than I want to is that you have to think about the stock market in a comparative analysis, in that you're comparing everything to the opportunity cost of every other stock you could buy at that time. And I have many other businesses I like and think are much stronger than Disney in my portfolio. I mean, just in the stocks here, I think Microsoft is better. I think Visa's better. But as we wrap up Tuesday's market analysis, all my accounts are down 1.32%. That's $2.8 thousand. And Disney down 9.51%. Those are the two major factors bringing it down today. Oh, and guys, I forgot to mention that I bought one more share of Starbucks today at $72.18. And this is really just a continuation of what I've been doing since last week. I covered Starbucks earnings on the prior episode and in the newsletter. But yeah, the stock has a 3.14% dividend yield, under 20 times earnings. And I do think the recent decline is slightly overstated, but that's not to say they don't have their short-term problems. So anyway, see you guys tomorrow. All right, so I just got a little package in the mail today, and it is related to our merch operation. And if you can see, there's a little Dividend Data logo on the box. And let's see what's inside. Oh, a hat. A second hat. Now, what does this say? Make dividends great again. We got a little American flag on the sides. We got Dividend Data on the back. Adjustable dad hat, you know. We also have a white hat with green text. Make dividends great again. Repping the Dividend Data. This is available at shop.dividenddata.com. In addition to our Buffett Munger 2024 merch. I don't know if you can tell, we have a little bit of a election theme. This is a limited edition for this year. And both of them, they have a certain thing in common in that I thought they were funny. So I made them for myself. And in kind, I am offering it up to you guys. So check it out. All right, guys, welcome to my portfolio update on Wednesday. The total value of my accounts is $219,700. That's an $80,000 unrealized gain, nearly a 58% total return. Microsoft is up 0.29%, Tesla down another 1.74%. With Tesla, I'm probably going to start buying if it goes into the low 160s again, because I do think the second half of the year will be very strong for their stock with all the full self-driving announcements, robotaxi event, low-cost car event, possible FSD licensing deal with other car manufacturers, and FSD robotaxi approval in China, which is a big deal. Broadcom up 1.71%. I really like Broadcom's business model with how high margin their products are and where they don't have to manufacture any of the chips themselves, so they don't have that major CapEx expense, which I really like. However, I think it's undeniable that the stock is overvalued right now. It seems to have gotten a lot of this semiconductor surge, which makes sense in areas where AI has created a boom, but for Broadcom stock, it really has not so far. I mean, I'm still waiting to see it in the results. Growth has not accelerated at all. And the last time I checked, most of their product portfolio has nothing to do with it. Starbucks up 1.38% today. So no buys on Wednesday, but still thinking about the market, following up with everything. So in the spirit of the Berkshire Hathaway annual meeting being this past weekend, I thought it'd be good to go back through some of my favorite Warren Buffett clips. In recent times, we live in a highly inflationary environment. This erodes the value of the dollar and its buying power. So what do we do about this? Well, my approach has been investing my money into productive assets. Specifically, a lot of that has been in high cash flow businesses with growing dividend payments. These are companies which are able to absorb inflation, raise their prices, and continue growing their profits even through an inflationary environment. And the best part is this is a long-term strategy with massive compounding effects. It's not just something you do during times of high inflation. And you don't have to change your investing strategy. For example, over the past few years, you've been hearing a lot of people say, oh, you need to buy gold now, or Bitcoin's the digital gold, get in on Bitcoin. However, there are major problems with those arguments. And to address those, I thought of a great idea to go back to some of my favorite Warren Buffett clips. I was in a little bit of a Warren Buffett mood, and in the clips I'm about to show you today, he lays out such a fundamental understanding of productive assets versus non-productive assets that I think really help frame this idea of investing during times of high inflation, and of course, the massive long-term compounding that can come from owning productive assets. And it really kind of burst the bubble of the idea that gold is a store of value. Sure, it may be a store of value relative to the dollar, but relative to investing in productive assets, not even close. Let's go to the clips.
Gold would be way down on my list as a store of value. I mean, I would much prefer owning 100 acres of land near here in Nebraska, or an apartment house, or an index fund. Gold, still, if you go back to 1900, you know, you were talking $20 gold. Well, you take 20 to 400 in 100 years. The Dow went from 60 to 12 or 13,000, and then 12,000 or whatever it might have been in that same period, and paid you dividends during the time you owned it. It was 66, I think, at the start of the century, and I forget what it ended, but it's 11 or 12,000. And like I say, it was paying you something every quarter during that period. And if you own gold, you paid $20 in 1900 or thereabouts, and then we'll say you had it $400 100 years later. It's not a store of value.
This is a very important point to understand. When you buy gold, you're still going to have just that amount of gold in the future. And the value will be whatever other people are willing to pay for it. Versus when you buy a productive asset, in this case, a business, it is earning cash flows year after year, growing, reinvesting in itself, becoming an entirely different entity with new business models and investments. And every quarter, it's paying you dividends. And you're reinvesting those into new productive assets, which creates a massive compounding effect long term. So in the example he gave, over 100 years, not only did stocks on the price front crush gold, but when you factor in reinvesting dividends, it gets even crazier, the difference.
I'm not arguing for paper money, but if you're worried about paper money, it makes a lot of sense to worry about paper money over long periods of time. But it's just about the last thing I would want to own under those circumstances. It has a farm as utility, an apartment house as utility, a business, will produce earnings, and to some businesses will produce them in real terms as they go along. I'd rather have the ability to sell people a pound of candy 20 years from now, and if they're dealing in seashells, I'll get an appropriate number of seashells.
As Buffett says, you should be worried about the dollar. It's going to erode in value over time. That's our inflationary environment that we create. We have a 2% inflation target even. So the target is that it's going to lose value. So you need to invest. And investing in productive assets is the real store of value compared to something like gold. Even if the dollar inflates to crazy high amounts, or we are forced to have an entirely new currency, owning actual businesses is still the better path. These things create value in society. They sell a product or service that people want. So no matter what the currency is, these businesses will adjust to that change in currency. In our current times of inflation, they'll raise prices. And in an economic collapse, maybe See's Candy will start, accepting seashells, as Buffett said in the example. Or if it's a nuclear apocalypse like Fallout, they'll accept the Nuka-Cola caps. The bottle caps are the currency in that world. Fiat currencies especially are not an investment by any means. And these non-productive assets are not investments either. I mean, they're much preferred relative to the dollar, but businesses are where the value creation is. Here's another clip where Buffett just flawlessly breaks it down.
When you buy a farm, you look at the crop every year and what prices are, and you decide whether it was a satisfactory investment. I mean, you look to the asset itself and what it produces for you. When we buy a business, we look at what the business earns and decide how we feel about it in terms of what we paid. But we are buying something that at the end of the period, we not only have what we bought in the first place, but we have something that the asset produced.
So this is the key point. When you buy a business or a farm or a apartment house, you still have the asset, but you also have all the cash flows that it paid you over time. And you can reinvest those into other things. And the best part with businesses is that they retain a large part of those cash flows and they'll reinvest it into their own business or acquire other companies. So in that example, the business isn't the same business. It's much larger and evolved over time. So the actual business has increased in value.
And when you buy non-productive assets, all you're counting on is whether the next person is going to pay you more because they're even more excited about another next person coming along. But the asset itself is creating nothing. One of the interesting things, for example, is gold. If you go back to the time of Christ and you look at how many hours of labor you had to give up in order to buy an ounce of gold, and you take it forward to now, you'll find the compound rate maybe 1/10 or 2/10 of 1%. And then you have to insure it during that time and make sure somebody doesn't steal it from you and everything. But it doesn't produce anything. And productive assets, you can pay too much for a productive asset. But I bought a farm in the 1980s, and every year look at how much it produced the way of soybeans and corn. And at the end of that period, I've still got the farm, and I've gotten some significant income off of it. Apartment house, operating business. If you had bought gold in 1942 and you say, we might lose the war and we might have to run off to some other country, and so let's put our assets in gold, you would have less than a penny for every dollar you got from owning stocks. Less than a penny. Now, if somebody calls that a store of value, I mean, I think they're delusionary.
Okay. You would have less than a penny for every dollar had you invested in stocks. There's always a reason that you can come up with to flee into these stores of value. However, at a fundamental, basic level, you want to be investing in productive assets. These are the real things that create value in society. When you create a business, they're selling a product and service to customers. That's an exchange of value. When you build a house or you have an apartment house, you're providing shelter for people and they're paying you rent in that exchange of value. When you buy a farm, you're growing crops or livestock or whatever, and you're providing value for people. It's all about the value provided. When you buy gold, you just have the gold. Nothing is being created for anybody. So at that fundamental principle, it only makes sense that one would outperform the other over the long term. And here's another clip where Buffett basically just makes fun of gold.
But if you take all of the gold in the world, don't get too excited now, and put it into a cube, it will be a cube that's about 67 feet on a side. It'd be 165,000 or 170,000 metric tons. So you could have a cube, but it isn't going to do anything. It's all you are doing when you buy that is that you're hoping that somebody else a year from now or 5 years from now will pay you more to own something that, again, can't do anything, but you're hoping that the person then thinks that somebody else will buy something 5 years later from him. In other words, you're betting on not just how scared people are now of paper money, you're betting on how much they think a year from now people will be scared 2 years from then on.
And this is another really important point. What he's describing here is the greater fool theory, in that for any non-productive asset, whether it's gold, whether it's Bitcoin, whether it's any crypto coin, any commodity, any Pokemon card or anything, the only way you can get a return on that value is someone in the future has to value it more. So you're speculating that someone in the future will want that item more. So you're hoping for that greater fool in the future, someone who wants it way more than you did. When you're investing into businesses, it's an entirely different world. You're valuing it based on what the asset produces. To an extent, it's irrelevant what anyone else thinks about it. Sure, the public stock market has its crazy fluctuations and bull runs and bear markets, but over the long run, there is a value to the asset itself. And if you just look to the cash flows it produces and ideally pays you via dividends, it doesn't matter at all what anyone else tells you about it. You're still getting paid that.
Anytime you buy an asset that can't do anything, produce anything, you're simply betting on whether somebody else will pay more for, again, an asset that can't do anything.
I would rather trust in the intrinsic value of a bunch of really fine businesses run by good managers selling products that people like to buy and have liked to buy for a long time, and them exchanging their future efforts, the money that comes from their wages for See's Candy or Coca-Cola or whatever, than take some piece of metal that people dig out of the ground in South Africa and then put back in the ground at Fort Knox, after transporting it and insuring it and everything.
I couldn't agree more. And it's for that reason that I invest in this portfolio of stocks. Sure, I pick individual stocks, but an ETF or just the S&P 500 index fund, they're all great. All of these are real businesses that create value in society. And just look at Visa. You want to talk about beating inflation. The dividend's growing at a 17.5% 3-year compound annual growth rate. We've had crazy inflation and this crushes that. These are real businesses with real products and services and real cash flows that they're making. And they can distribute that to you. And while inflation is terrible for the economy, owning productive assets is not only one of the best paths to survive inflationary times, it's one of the best long-term anyways. It's a no-brainer. All right, guys, it's Thursday, and I'm here to provide my final market update. We're ending the week at $220,200 total value. That's an $81,000 unrealized gain, 58% total return. And I really didn't buy much of anything this week, which, that happens. I think I bought 1 or 2 shares of Starbucks. Disney stock went down from earnings, but it didn't hit any of my buys. Visa, which I was targeting, didn't go down enough to hit any of my buys. Let's hope for next week. Leave a like, subscribe, and if you want a free trial of dividenddata.com, enter the promo code TRIALMAY. Make sure you select the monthly plan and it will give you 1 free month. Goodbye.